Monster Beverage beat Wall Street consensus for Q2 2026. Record net sales of $2.54 billion, which is a 20.2% increase year over year. Adjusted earnings per share came in at 60 cents, beating estimates of 58 cents.
Right. And the forward guidance looks solid, too.
Yeah, July 2026 sales are up approximately 14%, with selective U.S. price increases planned for Q4.
But the stock reaction.
That's the crazy part. It was largely flat after hours, trading around $94.16 after a regular session close of $94.24.
Barely moved an inch.
So you're listening to a deep dive into Monster's Q2 earnings report. Our mission today is to unpack the mechanics behind this massive quarter, right? We're going to analyze how their explosive international growth is impacting their long-term margin profile.
And, whether Wall Street actually thinks the current valuation is justified.
Exactly. Because, if a company completely crushes revenue expectations and crosses the $2.5 billion mark for the first time ever in a single quarter...
You'd expect a huge rally.
Right. You'd expect the stock to absolutely surge. But instead, it's practically yawning in after-hours trading. Why is there such a massive disconnect?
Well, the market is rarely just reacting to the cash a company deposits today. Institutional investors, they're a forward-looking discounting mechanism.
Right. They're always looking 6-12 months out.
Exactly. So they take that $2.54 billion and they rip it apart. They want to see the underlying machinery. So a 20.2% top-line jump is great, but beneath that, there are some really aggressive structural shifts happening.
Shifts in how they actually generate the cash, right?
Yeah. And more importantly, the rising cost to acquire that revenue. Investors aren't pricing in today's win, they're pricing in tomorrow's profit margins.
That makes sense. So let's break down where that 20.2% growth actually came from, because I think that's the key to the market's hesitation.
For sure. Let's look at the segments.
Right. So the core engine, the flagship Monster Energy drink segment, which has the classic green cans, Reign, and Bang Energy that is still an absolute powerhouse.
Oh, yeah, pulling in $2.36 billion.
Yep, up 21.6%. And then you have the strategic brands division, which is like, the more affordable stuff like Predator. That grew 10.6% to $143.7 million.
But then there's the alcohol brands segment.
Right, the glaring weak spot. It dropped 15.2% down to $32.2 million.
Honestly, though, that alcohol decline looks like a red flag, but you need some context there.
Because it's such a small piece of the pie.
Exactly. Alcohol is a totally different beast. The distribution, the regulatory compliance, fighting for shelf space, it's vastly different from selling caffeinated sugar water.
Right.
It's a tiny fraction of the business. Management even said that if you strip the alcohol segment out completely, their foreign currency adjusted sales would have been up 18.5% instead of 17.9%.
So it's basically a rounding error that's just dragging down the optics of the core engine.
Pretty much. Total energy drink case volume was up 22.3%. They moved almost 305 million cases of energy drinks this quarter.
Wow. 305 million. The volume is just staggering. But the geography of that volume is what we really need to talk about, right? The international numbers are insane.
Line of store, yeah.
So sales outside the U.S. surged 34.6% to $1.16 billion. International is now making up 46% of their total net sales.
Almost half the company now.
Yeah. Latin America is up 56.1%, Asia Pacific up 35.7%. The EMEA region, Europe, Middle East, Africa, up 27.2%.
And the specific country callouts were even crazier.
Oh, I know. Brazil up 82%, India up 84%, China up 62.5%. Those are software company numbers.
Right. Seeing that for a physical consumer packaged goods brand is incredibly rare. And if you look at the market share in the U.S., they gained 70 basis points.
Which is what? Just under 1%?
Yeah, 0.7%. But in a highly saturated market like the U.S., gaining 70 basis points is a massive operational win.
Right. They're stealing that directly from competitors.
Exactly. But in the EMEA region, they gained 220 basis points. That's 2.2%. It shows exactly where the frontier is. They are executing a massive land grab in these emerging economies.
It's funny, looking at this international expansion, it really reminds me of a blockbuster movie franchise going overseas.
How do you mean?
Well, like, a superhero movie might make $1 billion globally, right? But the studio actually takes home a much smaller cut of that international box office compared to what they make domestically.
Oh, right, because of the foreign distributors and theaters taking their cut.
Exactly. They have to cut these complex deals. So is this massive international expansion secretly diluting Monster's profitability?
It absolutely is. And that is exactly what institutional investors are laser focused on right now.
Ah, okay.
The engine for this whole international strategy is the Coca-Cola bottler network. Think of Coke's distribution footprint as like the Apple App Store for beverages.
Oh, I like that analogy.
Right. You get instant access to billions of consumers worldwide. You don't have to build your own bottling plants in India or buy fleets of trucks in Brazil.
You just plug your formula into Coke's empire.
Exactly. It's incredibly capital-efficient market penetration. But just like the App Store, you have to pay a toll, a massive toll.
Because you're sharing the economics with the bottler.
Yes. And on top of that, when you go into emerging markets, the average revenue per case is just lower. Local pricing dynamics, purchasing power.
Right, a can of Monster in Mumbai isn't going to cost the same as a can in Manhattan.
Exactly. So they are deliberately trading their overall margin percentage for raw global volume.
Wow. And that trade-off brings us right to the balance sheet. This is the cost of growth we were talking about.
Yeah, let's look at the margins.
On the surface, gross margins actually ticked up a bit to 55.9%. Management said that was from proactive pricing and a good product mix.
But the operating margin?
Right. That's where the pain was. Operating margin dropped to 29.19%, down from 30.9% a year ago, and it missed Wall Street's estimate of 29.95%.
And that 76 basis point miss on operating margin is exactly why the stock was flat?
Because the 20% revenue beat was just eaten up by the cost to get it.
Completely neutralized by the operating costs.
Yeah, and the main culprits there were marketing and distribution, right? Distribution costs alone went up to 4.7% of net sales from 3.9%.
And their marketing spend has been insanely aggressive lately.
Oh, yeah, they're throwing money at these premium sponsorships to recruit new consumers. They've got Formula One driver Lando Norris, Morgan Wallen in country music, and they just signed that huge deal with the Big 12 Conference.
Which is not cheap.
No, definitely not.
Yeah.
And CEO Hilton Schlosberg actually addressed this margin compression head-on during the call. He said, and I quote, "We bank dollars, we don't bank percentages."
I mean, that is just a classic executive defense.
Right. I have to push back on that. It's a great soundbite. We bank dollars, not percentages. But isn't that just a convenient excuse for declining efficiency? I mean, mathematically, sure, their net income rose 19.6% to $584 million, so they were banking more physical dollars. But how long can retail investors accept this margin compression just for raw dollar growth?
It's a fair point.
Because at a certain point, throwing millions at F1 and global distribution has to yield diminishing returns, right?
Your skepticism is totally warranted. The whole banking dollars thing works beautifully when top-line revenue is compounding at 20%.
Right, when times are good.
But distribution contracts, freight logistics, those F1 sponsorships, those are basically fixed costs. If revenue growth decelerates but those costs stay high, the math gets really ugly, really fast.
Operating leverage works both ways.
Exactly. But you do have to look at the macro strategy here. They're grabbing market share while the category is hot. They said they're bringing new consumers into the Monster ecosystem at twice the rate of the overall energy category.
That's huge.
And they are funding this massive global expansion completely with the cash they generate. Over $500 million in net income this quarter alone. They aren't taking on huge piles of debt to do this.
Okay, that's a crucial point for anyone modeling this stock. You just have to accept that the revenue mix is permanently shifting toward these lower margin, high growth international areas.
Yeah, the baseline operating margin for Monster might just be structurally lower going forward than what investors were used to 3 years ago.
So if margins are under this intense pressure, we need to look at how management is actually fighting these headwinds day to day.
Right. What are they doing to stop the bleeding?
Exactly. And the first big tool they have is pricing power. They've already done low single-digit price hikes in EMEA, and they just announced selective U.S. price increases for Q4.
To combat the rising aluminum costs, right?
Yeah, but does the fact that they can do this prove how strong the brand is?
Oh, absolutely. Having the leverage to dictate pricing is the ultimate test. They raised prices in Europe and still posted a 22.3% increase in global case volume.
So people just do not care what it costs.
It proves the demand is highly inelastic. Their core demographic doesn't see energy drinks as a luxury. It's a staple. They'll keep buying it, even if it's 15 cents more at the gas station.
And a big part of that sticky demand is this shift towards zero sugar, right? The Ultra brand grew 19% in the U.S.
And in Europe, Monster has a 44.5% value share of the entire zero sugar category.
That is massive.
It's so hard for a legacy brand to change its public perception, but Monster did it. Traditional energy drinks had the stigma of just being liquid sugar and synthetic caffeine.
Yeah, total gut bomb.
Right. But by dominating the zero sugar space with Ultra, they broaden their demographic completely. They aren't just selling to, like, dirt bike riders anymore.
Right, it's health-conscious people, aging millennials.
Exactly. People who need the caffeine for work but refuse to drink those empty calories.
Which perfectly tees up their innovation pipeline. They mentioned a new female-focused energy drink called FLRT, spelled FLRT, which is an early launch, plus the full 2027 calendar coming at the NACS show in October.
Lots of new products coming.
Yeah, but honestly, while new drinks are fun, I really want to talk about their capital allocation.
Oh, the stock split.
Yes. The board approved a 2-for-1 stock split, executed as a 100% stock dividend, effective August 11th.
So for anyone listening who holds shares, let's just clarify how a 100% stock dividend works. It's basically identical to a traditional split.
They aren't handing you cash.
Right. Instead of cash, they just issue you one additional share for every share you own. Your share count doubles, the price gets cut in half, but the overall market cap stays exactly the same.
It's purely an accounting trick to lower the barrier to entry, right? For retail investors who might not want to pay $94 for a single share.
Exactly.
So
drops it into the 40s.
But right next to that split announcement is a glaring red flag for me.
The buybacks.
Yes. They have $900 million left in their share repurchase authorization, and they bought back 0 shares this quarter. 0.
Not a single share.
They have nearly $1 billion authorized. The stock rallied 65% over the past year. They have record free cash flow, and they didn't touch it.
It's wild, isn't it?
Is management silently signaling that they think their own stock is just too expensive right now?
That is exactly the debate happening on trading desks right now. When a company has that much unrestricted free cash flow and just halts its buyback program while trading near all-time highs, it heavily suggests they have very strict internal valuation discipline.
They love their business, but they hate the price tag.
Exactly. They don't love their stock at $94 a share. They'd rather hoard the cash. Maybe they're building a war chest for acquisitions or supply chain investments or
they're just waiting for a market pullback to buy it at a discount.
probably. I mean, the split makes it look cheaper to retail, but it does nothing to fundamental valuation. Halting the buybacks broadcasts that management refuses to pay a premium multiple for their own equity right now.
Which naturally pivots us to how Wall Street analysts are valuing the company, because they are highly divided on whether this stock has room to run.
Very divided.
On the bull side, Stifel raised their price target to $105, kept a buy rating. They love the consumption growth and the innovation pipeline. BMO also raised their target to $95.
The bullish thesis is all about momentum. You've got double-digit growth globally, the zero sugar success, and that unbelievable Coke distribution mode.
So they think it justifies the premium multiple.
Right. A bull believes you should happily pay more for $1 of Monster's earnings today because it's going to multiply way faster than a slower competitor.
But then you have the bears, or the neutrals, I guess. Deutsche Bank downgraded them from buy to hold, though they nudged the target up to 98.
And their primary concern is exactly what we've been talking about.
Right. They're saying the current valuation severely limits any upside. They're worried about tougher year-over-year growth comps coming up and that margin drag from the international mix.
If you're a retail investor, this entire debate comes down to one core concept: margin of safety.
Explain that for us.
When you buy a stock at historical highs, you're paying for perfection. The market is pricing in flawless execution. But buried in those bearish notes is a warning that growth will decelerate.
Some models are saying it cools to low double digits by Q4, right?
Yeah, and maybe even mid-single digits by early 2027. If top-line growth slows down even a little bit, but those massive distribution and F1 marketing costs stay fixed.
Margin of safety is basically 0.
Exactly. Now, management swears consumer demand isn't slowing. They pointed to July holding strong at 14% growth, but the real question is whether the absolute best-case scenario is already fully priced in at $94.
Right, so if you're buying here, your core thesis has to be that this international growth engine can just indefinitely outrun the margin compression.
It's a foot race. Top-line expansion in India and Brazil versus the bottom-line cost to service those markets.
Well, we've talked about the international boom, the zero sugar shift, the margins. But there is one final, incredibly technical variable buried deep in their outlook.
Oh, the digital transformation project.
Yes. Monster is shifting their global enterprise architecture to the SAP S/4HANA platform, and it's slated to go live on January 1st, 2028.
Which sounds like the most unsexy upgrade ever compared to like a Morgan Wallen sponsorship.
Totally unsexy.
Mm-hmm.
Software upgrades never make the retail headlines. But think about the mechanical reality of everything we just analyzed.
Right, the logistics are getting infinitely more complex.
Exactly. Freight, fuel, bottler distribution, it's all eating into their margins. As they push deeper into emerging markets, the sheer volume of data they need to optimize those supply chains and execute local pricing is mind-boggling.
It's a massive logistical web.
So could this multi-year, boring software upgrade actually be the hidden catalyst that rescues their operating margins by the end of the decade?
It's a fascinating thought. While Wall Street is hyper-focused on whether a can costs 10 cents more to make next quarter, the real story is how Monster digitizes its global footprint to finally bank both dollars and percentages.
Exactly. Something for you to keep an eye on. If you want to keep unpacking the mechanics behind the market and stay ahead of the curve, make sure you follow the show for our daily earnings coverage.